There are three main topics that we want to discuss: tokenization and digital securities, decentralized finance, and asset management for crypto. And I'm very happy to have a very great group of panelists. So, Jason, I'll start with you. If you guys can introduce yourself, start after first grade.
Yeah, sure. So I'm Jason Guthrie. I work for Wisdom Tree Asset Management. We're primarily an ETF provider, but also doing quite a bit of work in the digital asset space. And my role is head of capital markets for Europe, as well as sort of spearheading the work we're doing in the crypto space.
Graham.
So I'm Graham Rodford, the CEO, co-founder of Archax. We're looking to be an institutional digital securities exchange in the UK. We applied to the FCA about a year ago and hoping to get our permissions in the next few weeks.
And Richard Crook, Director of Lab 577. We sit in the nexus between emerging tech and financial services. We're helping some of the biggest financial institutions get onto the Corda network.
We need longer interest to give some time. So, Graham, I'm going to start with you. So security tokens or digital securities is a topic that is very close to my heart. A year ago, 2 years ago, it was supposed to be the next big thing in crypto. Everybody was rallying behind it after the ICO bust. Everybody thought that STOs were going to be the next big thing. Nothing has really happened in that market. So, what are the causes? What are you attributing that to? And what has to happen in the market to wake up?
Yeah, so I think you're right. Kind of out of the ICO boom came an interest in digital securities, and some of that was through people not understanding the distinction between a security and otherwise. So there were some people that kind of entered the market without realizing what they were creating, but there were others that legitimately tried to create digital securities. Now, for securities to be of interest to people, the underlying proposition always has to be of interest anyway. But there's only so much you can do with blockchain technology in the absence of any form of secondary market or adoption. So whilst people may be going out and raising money for digital securities, without it being able to be traded on a secondary venue, without there being more widespread adoption and education, it's actually quite hard for the value of digital securities to be realized. And I think coupled with this, there's a view that digital securities can only represent these esoteric asset classes. So people talk about tokenizing properties, tokenizing SMEs, or whatever it may be. And the reality is that those assets are hard to market anyway. And if secondary markets exist, they're quite clunky. Whereas what we believe in is more that every asset class will move on to a representation of ownership on a blockchain, which essentially is a digital security. So I agree that it's been a while for adoption for the asset classes that are yet to be digital. But I think actually over the next 10 years, we'll see wider adoption. And you can see it already with companies like LSE and the Sandbox with Euroclear and Navora, companies like Six working on their digital asset exchange. They're all getting ready to build the infrastructure so that widespread adoption can take place.
Jason, could you expand on that? You obviously invested in this space. You are a believer in digital securities. What's happening to the market and what has to happen for the market to reach its potential? Jason, that's you.
Sorry. So I think in order for kind of institutional usage of digital assets to really take off, we need to think about, I kind of think about this in two ways, right? First is, from a cryptocurrency perspective, this is an asset class for investment into that product. What do we need to see for that to really grow, for institutional money to flow in? And people have been talking about this for a long time as the next leg of growth. And the second area I think about the growth of digital assets is more from the blockchain ecosystem perspective and the changes that we could see to, say, the way in which assets are held or settled or custody, or the way those processes are managed, and how digital assets can then fit into that phase. So I think we can kind of split both of these. Thinking about the first one, we've definitely got, I think, a couple of hurdles for big adoption for that market to mature. The first one is around kind of access and holding, and this is kind of a lot of what we try to solve for with the exchange traded products. But institutional clients, having a look at the crypto market functioning so different to what they're used to is a real barrier to adoption. But I think maybe the bigger one, rather than like the practical implementation issues, is around the way in which they conceptualize these as investments. And I think there's a big education hurdle that needs to be done by the industry to really get that institutional space up the curve. I mean, we've been on the road for the last sort of 3 months or so since launching the product, talking to these institutions about where they are, and the spread in understanding of the space is huge. And so really working with consistent messages around how this adds value to their processes, how this is going to improve sort of, their day-to-day, their investment outcomes, their clients' investment outcomes, I think is going to be the big one. And that's whether you're talking about the crypto stuff or the infrastructure side.
So, Richard, what are the things that I can do with digital securities? What are the use cases that we can enable that you cannot do with traditional securities?
So I think if you look at why people are coming into the digital security space, coming into the tokenization, some of the benefits that we're starting to see from that, very much the first and foremost one is around the settlement space, where institutions spend a great deal of their time trying to settle, having done the trade, having agreed the price, then actually getting to a settlement position. The trade settlement process still takes a huge amount of people and process. And it's that everyone's looking over in the digital or in the crypto space and saying, actually, settlement is relatively easy. In fact, they can do it with little or no cost. And that is the key thing they want to bring across into the institutional space.
So, Jason, I'm going to go back to you with this. So, expanding on that point, to me, the biggest promise of security tokens, at least conceptually, is programmability, right? Is I can program stuff with these assets that I can only dream of. However, we're not seeing any of that, right? We're seeing assets that are just a replica of assets that you have in the real world. Why is that? And again, what has to happen for us to break through that challenge?
So if you look at that as people are walking before they can run, which is the correct way around. They're trying out cash. They're trying to issue their own currencies. We've tried that now over the last few years. We're moving up through the different financial instruments, and they're getting more complex. When you then move up to things like structured products, you'll recognize that the administration of that structured product is actually quite costly. And so institutions are starting to look at that programmable contract as a way of creating efficiency in being able to do it. But there's another point to this, which the institutions are much more interested in. The smart contracts and the programmable piece will come. They're much more interested in the mobility. So today, when you list a security, you list it on one exchange. And that exchange will be where it's birthed and where it dies. Actually, we're now looking at a whole series of exchanges, and you look down on that floor, there are a whole series of exchanges who are all listing the same digital assets. Bitcoin, Ethereum, those are the currencies. But as we move into securities, as people come into the regulatory arena, we're starting to see the emergence of exchanges being able to list digital assets, but those digital assets can move from one exchange to another. And that may fragment the liquidity, but much more importantly, it breaks down the monopoly that we've seen to date in each jurisdiction.
Jason, pick that up. Why no programmability in this one?
Also, look, you're right about the potential efficiencies are out there. The idea that you could have something programmable versus manual, there's obviously a huge step up in efficiency there. But for most of what's being envisioned and people are putting out there at the moment, there's a really steep adoption curve. The infrastructure, the processes, the controls that are needed to use something that exists in a digital asset world on a blockchain, as opposed to a centralized custody model with exchanges they're familiar with that have members in clearing and all of these sort of market infrastructure, I would need to set all of that up in parallel as an institutional manager to start using those digital assets. My old ones sort of work within my processes, so I need to outlay a lot of capital investment resources and build to actually start using those. So people are then doing, a cost-benefit analysis to the savings versus the investment. And I think we'll start to see that equation make sense for people to do a build. But I do think as a anyone that's committed to this space, anyone that can see this future, needs to be working toward the incremental adoption. I think it's very rare that we see cliff edges in changes in these, but the more that we can smooth that transition or make that curve a little bit shallower, I think that will be hugely helpful to the adoption of these things.
So I think
Okay, let's talk about security token exchanges. So, because the STO movement came after the ICO movement, we sort of modeled the marketplaces after centralized crypto exchanges. And everybody sort of assumed that we were going to tokenize stuff and trade it like normal liquid assets. There were a number of exchanges that came into the market, all your competitors, and they're not doing very well. Like T0 is having a ton of issues. Open Finance has been listing tokens, but there's no liquidity, a very, very minimum volume. So my question is, are exchanges necessary in that type of traditional trading exchanges, or this type of marketplace is going to evolve more like a passive investment model in which I can list the tokens and I will buy them, but they won't be actively traded?
I think there's a lot of points feeding into that. So I think however much one embraces cryptocurrencies, the reality is that the biggest exchanges out there, like Binance, operate fully centralized models where pretty much all of the transactions don't happen on a blockchain. So even at the most extreme level of people that are Bitcoin evangelical, they really don't embrace blockchain and programmability for all that it can be. So a centralized model is still favored there, and whilst decentralized exchanges sound great, the reality is that they just won't fit with regulation right now. And to Jason's point, so much needs to be built around them that satisfies regulation that you just can't have a decentralized model. Part of the reason that Shares Post, T0, Open Finance networks, that they're struggling at the moment is we're still really early on. They are, if we looked 6-7 months ago, I think T0 had 2 tokens, Open Shares, Shares Post had a couple. I think they're up into the teens now. There are some interesting products coming to market, but the chances of finding good quality assets that have raised money, that can list, that embrace digital securities, and then finding liquidity and market makers in that environment is quite difficult. So it's going to take a while, but all it will take is a couple of decent products that decide to natively issue a digital security from the outset, and things will change. So you've got Wisdom Tree, obviously, just done a deal with Securrency. They're starting to look into the space. There are other investment managers actively looking into it right now to issue investment funds of hundreds of millions that will make these marketplaces a more attractive place to be. So I think once you start getting decent quality assets, more people will move to the markets, liquidity will increase and further help promote the area.
Can you have something, and again, this is a very personal opinion. So everybody talks about liquidity like the biggest hurdle for this to happen, right? But also everybody talks about the fact that liquidity is something that is just going to happen by an act of God or by having high quality projects. And in traditional capital markets, liquidity is something that you engineer for, right? It's not because you list like a great real estate asset there. People might not come because there are no disclosures, there is asymmetry of information. So are there things that can be done like tokenizing semi-liquid assets or things like that, shortcuts, to try to help with the liquidity in the space?
I think the liquidity is interesting. We don't subscribe to the idea that we put everything on Archax or an exchange and suddenly you get thousands of trades per second. But what you do is you facilitate any liquidity that could be there. So if you take any typical landmark building around London, it's probably traded between a few sovereign wealth funds or institutional investors once every 7-8 years. That doesn't mean it's not possible to get liquidity more frequently or that there might be other people interested in investing. It just means there's no accessibility. If you tokenize that or fractionalize it in a traditional way and make it more accessible to people, you'll release any of the liquidity that's there. And it doesn't have to be that it's traded once every 7 years or a central limit order book. It could be a quarterly auction, a semi-annual auction. The point is to find the best liquidity pinch point for each of those assets to maximize price discovery.
Yeah, so Richard, expanding on that, is our security tokens or digital securities, a bigger opportunity for emerging markets outside the first world. Like we're in these markets in which that are very efficient. We have access to invest in passive products, in active vehicles, and we think it's all perfect. But if you're in somewhere in Africa, there is no way you can access to an ETF or a vehicle like that. Or tokenizing those vehicles a bigger opportunity for emerging markets than for first world countries?
So I think if you look at this with two dimensions, the first and foremost is you're absolutely right. Over the last 30 years, we've invested a tremendous amount of money in improving the capital markets around the public listed equity and debt. To think that we're going to just overnight tear that all up and start again is not going to happen. Just beneath that is a growing private debt and private equity, and I don't mean the private equity in the companies, I mean equity that is in private shares, that is growing. There is a smaller and smaller number of shares being listed on the exchanges. It's a smaller and smaller number of debt being listed on public exchanges. So that's a growing need or demand for that accessibility to that growing asset base. So what you're seeing with the securities and digital securities is how do we securitize that and get that into the investors' hands from that. So that's one theme that's clearly growing over the last decade. The second one, to your point about emerging markets, is that emerging markets have, until recently, always been coming to the more developed financial centers for capital. We've done depository receipts, we've done reverse listings. All of those have been an attempt to try and get foreign investment into those emerging markets. Over the last 20 years with globalization, the cash is now the other way around. And we're seeing a huge amount of cash build up out in Asia, I would say, but there are other emerging markets who are now looking to try and find yielding assets that they can then invest in. And one of the reasons you've seen the rise of Bitcoin was the offshoring of wealth from China. And that theme is recognizing that there is a new asset class in digital assets coming in from two sides.
Okay, so I'm going to stay with you for a second because months ago you worked on a project that it wasn't a digital security, but it shared a lot of commonalities that was based on the Corda blockchain. So the 100% of the digital securities in the market today have been issued in the Ethereum public blockchain. And none of them particularly have worked. So there is a line of thinking in the markets that probably the first layer of adoption is going to be between institutions using permission blockchains to tokenize these assets and exchange maybe a private bond, a fixed income product between 4 banks or something like that to get started before going into public blockchains. Do you subscribe to that thesis, or do you think public blockchains are just going to be fine?
I think what you saw in Ethereum in 2016, 2017, or 2017, 2018, depending on when you started it, that ICO bubble that came through gave us a disruption, showed us how to raise capital in a different way. But the public blockchain of Ethereum has fundamental flaws in the fact that it's a shared everything architecture. So if you want to see all your transactions, that builds up trust. But to a great less extent, most of the regulatory requirements and the commercial requirements need to have privacy. So it's not really about permissioned or public or private. You want a public network. There is a Corda public network. There is an Ethereum public network. But what you're looking for is privacy in your transactions.
So if Ethereum incorporated CK Snark, CK Starks, whatever of those protocols for privacy or identity, would that be a step in the right direction?
So what you discovered in 2016 was a conversation about zero knowledge proof, and that was a distraction to try and solve a problem that you've already shared. So you've got to recognize that when Ethereum was built, it was shared everything. The whole point of starting again with Corda in 2016 was to create a shared nothing architecture that we could then build a finance grade ledger and then build on top of. If you look at what we've built in the public Corda network, over time we're bringing entities onto that, you have to be identified on that network. There is no ability to be anonymous. And one of the things you find when you're in the finance space is you're not allowed to be anonymous. The AML and CFT regs are very clear that you cannot transact with people who are anonymous. So it's a
Do
really
you
straightforward.
sacrifice other things like not having consensus protocols for change of ownership or things like that? Because if there are only 3 nodes in the network, I guess I get privacy without consensus. Or
If you look at it from a perspective of take it over time, the technologies are converging. So where Corda now meets those regulatory requirements, if you're trying to do securities or you're trying to do these pieces, on the Ethereum side, ETH 2.0 does not look dissimilar to Corda, and in actual fact, each and all of these technologies are converging over time. So it's only a matter of time before this conversation drifts away and disappears from view as the more important conversation about which securities and when is when we get into it.
yeah. So Jason, recently you were involved in arguably one of the biggest financing rounds for digital security, 17 million into Securrency, that is a tokenization platform company. Not many digital securities startups have been able to raise capital, which poses a challenge. Like there is not a whole lot of competition in the space. As a VC, I certainly invested in a couple of those, but how do you see the market? What's the climate for raising money for digital securities startups? And if it doesn't get better, are we going to face something that a lot of those companies just run out of cash and they cannot?
So it's kind of a lot there. I think, look, I don't see the digital security space as being necessarily more challenging than anything else. I think what is maybe a bit more challenging is people being able to convey a convincing vision of what that will look like in the future. I think a lot of people, there is this pull and fro between public and private that we've just kind of alluded to previously. But I think, we talk about what's ahead for the next decade, what's the 10-year view, and this is starting to, I think, position for that. I think, when we had a look at this investment and at going into the tokenization, AML KYC on the blockchain, which is what really Securrency focuses on, we try to look to a world beyond what we do currently. Sort of the DNA of Wisdom Tree was, we do everything in ETFs because that was the best thing to do. The company was founded in 2006, but this was clearly a change in scenery from what we'd had before in the mutual fund space. This was a better way to do things. The efficiencies that you can see in digital assets, maybe it's not quite as ingrained quite yet, and maybe the pathway to adoption is a little bit harder, but there's definitely potential for another sort of lockstep order of magnitude change in the way people go about accessing things. And I think, taking a position to continue to help build and push the boundaries on that is really what we're looking to do. So kind of what that means for the broader space on funding, I haven't necessarily got a view on that, but what I do have a view on is I think the importance of trying to drive this technology from a firm that really has worked very hard over the last 10, 15 years to provide best-in-class ways to access markets. And we think that's what this can potentially represent.
So, Graham, you're in the middle of raising capital for Archon, or almost done, I guess. Again, same question, but maybe a little bit more direct. There is a phenomenon in VC called like the Series A crunch. That is, a bunch of companies raise seed money, but they cannot execute to get to a Series A, so they literally need to sell out for peanuts. Do you see that happening? Is this becoming a market of 4 or 5 players and that's it?
Yeah, I think actually to pick up on a couple of points just made first, I think where we are is the problem is if you're selling anything and you're leading with the technology it's built on, then it's a problem. Like really, people want to invest in interesting products with decent visions and good business plans in place. So the problem when people are out there marketing a digital security and the business is second, you're almost off to a bad start. So to Richard's point, you almost want the technology to kind of fade into the background and just get to the point where people are raising money for interesting companies. It's just that the registration of ownership is on a blockchain and the processing of corporate actions and the like will be more efficient on a blockchain. So it needs to get there. And all the time we're leading with this kind of blockchain technology, you immediately whittle down the number of people that are willing to even look at your offering. So we kind of climbed the harder mountain in a way, deciding to be regulated by the FCA. 2 years ago going out saying we're building an exchange for digital securities when really there was no action whatsoever. It was a real struggle at the start. And then obviously, as we're getting closer to where we are now, it may seem like there's not mass adoption, but we're pretty close to getting regulated. The FCA have embraced us. We've raised most of our money. We're just working on our reg cap. And if you look along every asset class in the world, you'll find that most are being tokenized. So Tether Gold, CoinShares Gold, securities, blue chip securities are being looked at by LSE, SIX, ASX, Deutsche Börse. Real estate funds are pretty much the biggest use case of tokenization at the moment. Central bank currencies are all being looked at. So actually, when you look across every single asset class, what you realize is this isn't so much of the dream that it was a couple of years ago. Actually, it's all taking place right now, and we're closer than a lot of people think.
That's great. So I'm going to move from security tokens for a second and talk about asset management. And Jason, I'm going to go back to you because you have a unique experience in this area. You work with a lot of large institutional investors that are looking to adopt crypto. So most people think about institutional ETF as a vehicle for institutional investors to go into crypto. What are the challenges? Are ETF it? What other vehicles are out there that could be exploited?
So the ETFs aren't the only vehicle out there for people to take exposure. I mean, people can do it via futures. They can do it via ETFs. They can do it via they can do it via mutual funds, whether active or straight tracking products. They can also buy crypto directly. I think what we have seen is that the different products are going to appeal to different clients for different reasons. It's still very, very early days. Hedge funds, high-frequency trading shops are going to lend themselves more toward the futures market. These are guys that are already set up with the CME. They know how margining works. They understand that accessibility. But it's been proven that the futures route to market doesn't work for big swaths of the institutional space, whether that's family offices, private banks, multi-asset managers, pensions, insurance, right? There's a huge market for commodity exchange-traded products where essentially that product provides access to a future on oil, agriculture, whatever. And these are hugely popular in that space purely because that route of access doesn't work for those clients. Rolling futures, managing margin accounts, these are things that for a lot of the market is a big hurdle. Same operational hurdles come in when we have a look at, say, accessing crypto directly, right? So if we're talking about traditional fiduciary managers, these are quite risk-averse institutions. If you go and talk to them about opening an account with an unregulated entity and then free of payment sending them $1 million or however much cash you want to do, all of their risk managers are going to go berserk because that's just something they cannot contemplate doing from a risk perspective. Then there's the liquidity pooling of unconnected exchanges and everything that goes along with that. So now we're kind of left in the middle ground for at least where we are at the moment. Exchange-traded funds and mutual funds, I think, as the primary routes of access that we're going to see. The Grayscale product in the US is the biggest example of this with nearly, $3 billion odd worth of assets under management. And this is a really archaic fund structure. It's a closed-ended fund. You can only subscribe to it when they open the window, which is at their discretion, normally once a quarter, sometimes more frequently. You then have to hold the shares for 12 months before you can sell them in a secondary market, which currently trades at somewhere between a 30 and 100% premium. There are some active strategies out there, but they haven't quite had the track record that most institutional investors want. So I think this is why we hear so much noise about the exchange-traded products as a method of access. What people want now is something that solves their practical problems but gives them simple delta one directional exposure to the asset that they're after.
So Richard, quickly, if not exposure to crypto, the other thing that institutional investors are looking is to use blockchain technology to optimize operations. How is that happening? What are the killer scenarios in this day and age on the market?
So if you look at the financial institutions, they got into this by artificially splitting Bitcoin from blockchain. They wanted to leave Bitcoin away for the moment and focus on the actual blockchain technology because they could see that they could get operational bottom line efficiencies by looking at post-trade settlement in the capital market space, but in the wider markets or wider industries, they could help their clients in trade finance. And if you look across some of the projects that are coming back to Graham's point, what were dreams 4 or 5 years ago, you can now see people making good, strong ground on that. If it's inside the capital markets, it's things like HQLA and high quality liquidity assets. Or outside in the real economy, you've got things like Contour doing letters of credit, or Marco Polo doing trade finance. So that's a good example of where the actual technologies started to come through. That was always an artificial split between blockchain and Bitcoin. And I think what you're now starting to see is those two coming back together again as the financial institutions are realizing that actually people don't make payments for no apparent reason. They make payments in receipt of goods and services in the real economy, or in the financial services or capital markets, they make payments as a purpose of settling a trade that they've done. So always it's two legs of the same transaction. Doesn't matter if you're in the real economy or in the capital markets. And bringing those together on the same fabric, on the same technology or platform, is really what this has always been about. So the artificial split of Bitcoin and blockchain is now coming back together. And actually, it doesn't matter if you're in the crypto space, coming into the regulatory space and taking a regulatory license, or if you're in the regulatory space as a financial institution looking over at crypto and starting to be interested in doing digital assets or using blockchain for your operational efficiency. Over time, we're not going to see the difference between the two. And we're always reminded of the kind of last line of the Animal Farm, the book Animal Farm, where the creatures looked from pig to man and man to pig and could not see the difference. Give it 5 years, and I'm not going to see a difference between the crypto houses that are sitting down on that floor down there or the financial institutions that are sitting over in Canary Wharf.
Okay, so I'm a little bit tired of these guys agreeing on everything. So let's do rapid fire questions. They never seen the questions. Just simple answers. Don't elaborate, very rapid. If you got tokenized a single asset and that's all you ever gonna do, right? What would that be? So, please.
I would tokenize an interest-bearing. I would tokenize interest-bearing, probably US dollar asset.
Interesting.
I was actually going to agree.
Yeah, right.
Central bank stablecoin. I think it's what takes digital securities to the next level.
Okay.
I would say corporate debt actually come down the ranks, rather into the small, medium companies. That's where they could.
I'll tokenize the SEC. So is Ethereum the right blockchain for security tokens? Are we going to see a new blockchain for security tokens specifically? Yes or no? It doesn't matter.
Ethereum's the front runner,
Okay.
in my view.
It's not. Okay.
Not while somebody could do a 51% attack and reverse institutional money transactions. I think it's a problem.
Do security tokens need a new blockchain?
No.
Okay.
I think just work needs to be done on current projects.
Okay.
So I think there's an obvious weakness in that Graham's picked out. What you've actually seen is the financial institutions come together 4 or 5 years ago and actually go and build a finance-grade ledger. They call that Corda. Absolutely, Ethereum is the front runner. Just like Netscape, it's the first. But what you're actually starting to see is a lot more coming towards Corda.
Is there a non-trivial chance that security tokens don't work as an industry and die off?
It's not non-trivial. There's definitely a risk that
Okay.
this change doesn't happen, for sure.
I think that all you're asking there is, do institutions replace their ledgers with shared ledgers? And I think that happens. And as a result, I think digital securities are a thing. They're just not referred to in that way.
I think, to Jason's point, some people's belief and some people's dreams may not come to reality. But to Graham's point, I would agree. Actually, the institutions have spent the last 30 years getting to single sources of truth inside their houses, and they're now trying to get to a shared ledger across the houses.
So tell me one thing, last question, that you believe about digital securities or asset management that is very controversial and most people don't agree with you. Mine is that security tokens could die and never materialize. This one you can think like 10 seconds.
About digital securities, that's look. I think that we're at we're at a pivot point in time, we're at an inflection point in time with this technology that it's almost undeniably going to have a change in the world. But I think almost anybody out there that tells you they know what that is probably wrong. It's trying to pick what the world of the internet would have looked like in 1991. So I almost disagree with everybody out there that they know exactly where it's going to go, but it is going to change, and this technology is going to have a market impact over the next 10 years.
I sort of agree with that.
It's a similar point, really. I think the thing that's not discussed enough is interoperability, and everyone's working on their own standards, their own programmability, and when you look for things trading on a secondary venue or the like, what really matters is the technology is used in a central securities depository, and we need a coming together of institutions in terms of operational standards for the kind of dream of digital securities to be realized.
Richard, wrap it up.
I think the controversial one for me has always been around Bitcoin, about what is its longevity. To some people it would appear to be a digital gold, and it has longevity. For me, I continue to take a different view, where just like Netscape was the first and Bitcoin is the first, will it last? Will it be replaced by the next version? And that's, for me, a controversial view.
Guys, join me to thank you, my panel. Thank you very much, and thank you for coming.